Hello, everyone. Welcome to the show. We have one of the biggest GPs, general partners for those who know, in the business, someone who raises so much capital, but has such a unique story, which we're going to highlight on today. We have the founder and CEO of Generational Wealth, MD, and GW Capital, Param. How are you today?
I'm doing great, Craig. So excited to be on here with you.
Yeah, well, we're so grateful that we've earned the right to work with you on some deals and are looking forward to only doing more opportunities with you as time goes on. But you've got quite a unique story. You became financially independent very early in your life in the scheme of things. You raised a bunch of capital. You're raising kids. You've got a full plate. But let's learn about yourself. How did you get in the chair today? How do you manage so much stuff? What is your story?
Oh, thank you, Craig. First of all, I love partnering with the Lone Star Capital team, and we're very selective about who we work with. And we've had an absolutely fantastic relationship, and it works both ways. And I know you said I became financially independent early on. Knowing how young you are, it's probably not, relatively speaking, not early on. But let me deep dive a little bit into my journey. So I am a radiologist in Southern California. I immigrated to this country. 10 years out of training, around 2019, is when I had a rough career transition. That's when I realized, like a lot of people listening, you have a W-2 job, you're an employee, and you assume that income gives you financial security. But in periods of transition, that's when you realize that you really need more to lean into. You really need to have a steady stream of income, ideally outside of your profession. And so for me, there was a rough career transition. There was a 6-month period where things were professionally and personally not the best, I would say, probably my lowest point. And then right after things started settling in, the pandemic hit, and that for physicians, and I think for most of us, that was another transition we all had to battle. And that's when I realized that I wanted to have security outside of my job per se. And even being a high income physician, when I started looking at my passive income numbers, I realized that I was probably a fifth of the way there, and that's not where I wanted to be. I had started investing in real estate in 2014, and so I realized that I was making 6 times more in real estate than I was in. And I was owning it. I was owning these single-family homes passively, having property managers manage them. But even with that, I had a third of my money there, and I had about twice as much passive income from the real estate portfolio. So that was my big aha moment. That's when I realized that I really had to, if I wanted to accelerate things and I never wanted to be in that position again, I really needed to pivot. And I did. I had a 3-year goal. I said, in 3 years, I'm going to get to the point where I have, enough in passive income from my rental portfolio to take care of all of my family's needs. I hit that goal in a year, and that's because I shifted from passive to more active strategies. I started investing in short-term rentals and tapping into tax strategies, sheltering my clinical income from taxes. And then I got to that point, and I cut down to a day a week in medicine. And I wanted to, I really wanted to talk to more people about this because I felt like there's this traditional mindset, the traditional retirement path, stocks and bonds. And it would have taken me 17 years to do that with the stock bond portfolio. And it took me a year with real estate. And I thought that, more people needed to learn about investing in real estate. I wanted to break down barriers to real estate investing. I felt, and you know this, the ultra high net worth people, about 50% of their asset allocation is in alternative assets. It gives them diversification, but also gives them significantly higher risk-adjusted returns. And I wanted to educate people. So I built out the Generational Wealth MD community. We're at this point at about 20,000 professionals, mostly physicians, but we have professionals from all walks in there, and heavily focused on helping them invest both actively and passively. We started out with active strategies because that had been my journey. We have some physicians who are sheltering close to $1 million of clinical income from taxes. I mean, you can only do 620 a year, but you carry it forward if you can't use it. But there are people doing amazing things, generating like over 6 figures in income from one property, and they want to stay active. They love doing it. And then I realized that 85% of the community wants to invest passively in real estate, and they don't want to be that active. So we built out GW Capital to give people opportunities to invest passively, and where we're doing vetting, doing due diligence. I put my own capital into those deals. We go in as general partners, and yeah, that's been it. I just one size doesn't fit all, and we try to make sure everyone has options. And so that's been the journey.
Yeah, and everyone has different needs. And one thought that immediately comes to mind from listening to your story there and just kind of the kind of high level overview is kind of how you allocate your portfolio, how you look at money, your relationship with money and your relationship with investing. I think many people kind of come to realize is that if you invest in stocks and bonds, it's awesome. It's really great. We're not here to say that S&P 500 is bad, bad, not good. That's not what we're here to talk about. But your lifestyle and your income doesn't necessarily change too much if you're in those spaces. You have probably so many physicians, so many people in that world that, yeah, it's great to look at their stock account and see a couple $1,000,000, but a couple $1,000,000 for you working in the right real estate projects is truly meaningful capital that can start to, take you out of being in the practice day in and day out. Did you kind of have those realizations where you personally wanted to set that up yourself, and then you created this, massive group of people, after the fact as the byproduct of wanting to educate? How did that come into place?
Yeah, and when you talk about those numbers, like I said, it's always about asset allocation, right? So we're not saying it has to all be in real estate, but 2019, I realized that was the first time I heard about the 4% safe withdrawal rate. And so I thought, I'm making 10% annually in the stock market. I can always withdraw that. But if you want your portfolio to last you till, in retirement, you can only withdraw 4% from it, as opposed to investing in, say, syndications where you're getting 20% annualized returns, or investing in short-term rentals where you could be getting 100% ROI depending on how you invest. And so that's where you're compressing those timelines. And so that shift started becoming more and more important. Craig, what's the second part of your question?
Yeah, what did you have maybe a realization that it came to when you're like, oh, wait, this is actually the path that I want to take? Because if you've got a couple $1,000,000 in the stock market, your life and your income coming in from that is maybe very limited. But if you're in the right deals, the cash flow coming in becomes very substantial, which can kind of replace your day and time in the business, and you can buy back some of your time.
Yeah, absolutely. And when I looked at my portfolio back then, I had 600,000 in my stock bond portfolio, and I was like, well, that's a lot of money, and it should mean something. But once I applied the 4% safe withdrawal rate, I had 2,000 in passive income from that. And my needs at that point, and I live in Bakersfield, California, so I have geographic arbitrage. All I need is $10,000 post tax, right? I could probably get a fifth of that. And then I looked at my real estate portfolio. At that point, I probably had 200,000 in real estate, very, very passive, right? And I looked at my cash flow was about 2,000 a month, but I also had equity build up over time, right? And so I had another 100,000 over 5 years that I didn't even know to look for before. But then this was, itself significant in terms of cash flow. And so that's true for most people, right? And I mean, we're in the multifamily space. The cash flow you're getting from your deals over there is very tax efficient. And this is true if you have a single family home or you have a short-term rental. We have depreciation benefits. There are ways to work around taxes and defer taxes, and those are legal, and those are benefits afforded to real estate investors. So now you have a vehicle that's inflation adjusted, right? Over time, your returns are going to keep increasing, both from cash flow and your equity in the property, and it's tax efficient. And so once you start factoring all of that in, and people talk about compound interest as being the eighth wonder of the world. I'm like, think about leverage, right? Think about leverage that you have on inflation adjusted assets. I mean, that is truly magical. And so, so it starts really compounding very, very fast. And so $1 million in syndications, your annualized returns can be about 20%. But then again, once you start getting active in real estate, those returns can be significantly higher. And so, so that's the beauty. And I think even for people who invest passively, just seeing that cash flow hit your bank account on a regular basis, not having to pay taxes on it, and realizing that you're having equity growth over time, that's when you look at real estate, you need to look at not just cash flow, because I know we've been in times where cash flow has been lower, but that's beginning to improve. But you're also looking at equity built up over time, debt pay down, tax savings. All of those things start adding together. And that's why you're able to really compress those timelines to financial freedom if you're using real estate as a vehicle.
Yeah, and two other additional points here to really harp and hit on. These are the benefits to real estate investing, as many people who are listening to the show know. But number one is cash out refinances are in fact tax-free, so you don't get taxed there. Also, the 1031 exchange model and plan allows you to also compound those benefits that you don't get that. You can't 1031 exchange Apple stock into Google stock, but you can go deal to deal to deal when you do, in fact, syndicate, when you do, in fact, go full cycle with an opportunity. And a lot of the goals that we have now at Lone Star Capital, which I'm sure, Pram, you can speak to this as well, is we're not even in the business as much as raising new capital. We're just kind of re-raising our current capital to want to stay in the next deal with us by giving them a good experience. Can you maybe speak to that or relate to that kind of sentiment?
Yeah, I mean, and so, I think you and I both speak the same language. Once we start talking about it, there's so many things we want to add on to it. And so
Yes.
you're absolutely right, right? We talked about four things: the four cash flow, equity buildup over time, debt pay down, and tax benefits of investing in real estate. But there are so many other pieces to that. You can force appreciation, which is what, Lone Star Capital loves to do. We love to do, where you're not just, banking on market appreciation over time. There's the things in real estate where you can go in, you can execute a business plan that you have absolute control over. Tax savings is one part of it. You can force appreciation where you're increasing the property's value immediately without having to wait for those, for market prices to go up. And so forcing appreciation is one big part. But then, and then inflation hedge, right? Over time, your returns are increasing just because you're using leverage on inflation adjusted asset. What we don't know about the really uber wealthy is that they do the same thing, right? It's like they buy assets and they don't try to increase income, they try to increase wealth, right? Because like you said, cash out refinances, you're tapping into the equity that you have in a property, and that's completely tax free, right? So buy, borrow, die, right? Or swap till you die is something that people, really wealthy, always do. And so what they do is they buy assets, let it increase in value. When you tap into the equity, when you do a cash out refinance, and I think this is true even for people like Elon Musk and people who hold large stock portfolios, they borrow from those portfolios. So all the
Yes.
capital they pull out is tax free, right? Same thing when you do a cash out, when you're tapping into that equity, it's tax free. And you're essentially deferring taxes. And when you do exit deals, and which is why we love working with Lone Star Capital and other partners, where the goal for you as investors and for us, right, also is to keep swapping and deferring taxes, deferring capital gains, deferring depreciation recapture till you swap till you die sounds morbid, but the whole point is that at some point when your heirs inherit those properties, all of those gains and depreciation recapture is wiped out and their basis is
Yes.
reset. Right. So the smart thing to do, which is why, and people always say, oh, well, we can get bonus depreciation, but what happens when you sell the property? There are multiple ways to strategize around that. So you continue to defer having to pay those taxes till they are completely wiped out, which is the goal. So you really tap into those tax efficiencies. I'm going to stop and let
Yeah,
you
no.
go.
And to piggyback off that, what we're really talking about here is this little thing in the business called a cost segregation study. So you're basically taking the life cycle of what it would be typically speaking. Let's just say for a home, 27 and a half years you can appreciate. You're basically compressing that window so much that year one, you get an outsized dollar on cent return of depreciation that you get. And then the years after, a little bit less. It's basically in a 5-year window, if I'm not mistaken, a 5 to 10 year term that you get that accelerated appreciation in. But a lot of people like us, particularly in the multifamily space, we like to hold stuff for about 5 to 6 years anyways. So you really get a massive gain there, massive benefit from the write-offs you get in your K1. And then you go roll it into the next deal and you don't have any recapture from that gain. And then theoretically, if you are in those positions, if you have those deals, the rich, the wealthy do is they have those setups, they have that structuring there, they keep pushing their tax bill down the line. And then unfortunately, a little known thing, people do die, in fact. And when they do die and you are the heir of that, entity, of that estate, of that trust, however you put that vehicle in there, you get to inherit that property at a reassessed basis, but you don't own the recapture gains from the generation before. That is the generational wealth, no pun intended to the title of your businesses, that you get through the real estate vehicles that you really don't find elsewhere. So that is the benefits to real estate that some people don't necessarily always think about, but that's how you play the game at the highest level. And it's from people like you, which gets me so excited to get chills thinking about this, who are spreading the gospel of the real estate, wealth creation tool. It's such a special way to get wealthy. And we've kind of been in a weird world where people are getting really rich really quickly in the last couple of years. That is not going to last forever. That's not the norm moving forward. But when you did say these words like forced appreciation, when you do buy well, you will get rich, basically, more quickly than the average deal you would do, and with a more predictable cadence and consistency.
Absolutely. And you talked about generational wealth. The reason the community is called Generational Wealth MD is, yes, A, we want to, acquire and pass on generational wealth in the most efficient way possible. And some of that is tax efficiency, but it's also the knowledge, right? And I love that you're deep diving into all of this. Oftentimes, what you're showing your kids and you're modeling for them is how to build wealth intentionally and invest in real estate and break those barriers down for them. And so, just piggybacking onto what you said, Craig, a lot of people will come and say, well, we're getting maybe 5% cash on cash on this deal. How's that different from just investing in a savings account? I can get 5%. Most people don't realize, because it doesn't come out of your savings account, you're getting taxed on that at your marginal tax bracket. For someone like me in California, that's 50% in taxes.
It's actually probably
It's a
over.
lot.
No,
It
it's
is.
actually
It is
over for
over.
you. Yeah.
I know. It's
It's over.
13% state and then 39 federal. So that's definitely over. But
And wait, let's also not forget your property tax, which the property you own, and sales tax. So anyway, slice the cake. If you are a typical person, particularly with your scheduling, with your occupation, you have very few options. And the biggest bill a year is going to be your tax bill.
exactly. It's the biggest expense, and most of us just take it for granted and think that there's no death, and taxes are inevitable, but that's not true, right? That's what most people don't realize. Like I said, we have physicians who are working full-time jobs, who have 3 kids and they're running their practices, who also shelter the bulk of their clinical income from taxes using real estate, right? And then even for people who invest in syndications passively, if you have other single-family homes or other short-term rentals, there is a way to strategize around that. It's like pieces of a puzzle where you can put things together, where you can end up becoming super tax efficient. We didn't talk about the lazy 1031, Craig, and that's something a lot of us have used in the last 5 years, since, well, actually more than 5 years, since 2017, since the Tax Cut and Jobs Act, where, when you get into a syndication, you get huge tax losses, and which you can use to offset capital gains and depreciation recapture from other sales. So in the last few years, people haven't really had to do a traditional 1031 and be bound by those timelines. You can exit something and enter something else as long as it's within the same calendar year. Oftentimes, you're able to strategize around it where you don't have to have those tax implications, right? So there's been a lot of freedom. It still exists. We still are in a year where we have 60% bonus depreciation. And so any deals we enter before the end of the year, our investors do get to benefit from that. And then I tell people this all the time. Suppose you buy you acquire a single family home today, or you have stuff in your portfolio. Know that if you exit a syndication deal in the future, you may be able to bonus depreciate that property. If you acquired it in 2022, 100% bonus depreciation, take huge losses to offset your tax implications from the syndication. So as you're building your portfolio, I think it's important for us to just think about, it's this fun way to really strategize around taxes and really tap into the tax efficiencies that the tax code offers real estate investors.
Yeah, well, what's so funny there, Prom, is a friend to Lone Star Capital, I'm sure you know him, Bala, who is doing the 10Y program. He went out on stage to present Zen, one of his properties he's developing in the Cave Creek area, just outside of Phoenix, in kind of the greater Phoenix MSA. And he went on the deal pitch and it said 1031 exchanges for chumps, because the tax liability there, because the lazy 1031 exchange, which is so funny. Now, I philosophically view the world a little bit differently, as did Alan Steinberger, biggest investor with Park Row Equity Partners. But it was just very funny because he was saying that, and it's a different philosophy. But to your point, you do get really great benefits. And I think something to think about pertaining to real estate ownership, real estate investing is this, and I really want to stress on this. This is not the first time I've said this before, but the government doesn't care if you own real estate, but they incentivize you to invest and own real estate with how the tax code works. So that was something that was very interesting to me to think about, was that right there, that they will incentivize you. The two great ways to shelter and kind of the incentives that the government lays out for you are oil and gas, energy, and solar farming is becoming a lot bigger right now, and then real estate, providing shelter for people. So things like that are really accretive from a tax perspective that I think many people don't think about very often. So when you educate them, I'm sure they have a light bulb on aha moment, because these are really high earners. Doctors are very successful people. Doctors and lawyers particularly are taxed though the worst. They're, or a financial advisor. It's kind of funny. I pay basically very little in taxes the legal way, which is amazing. And I'm
Yeah.
sure you do as well. So when you do have these conversations with, your kind of avatars, they call it, the people you raise capital from, what are some of the pain points that you're solving for them? What are they typically looking for? I have to imagine they've got similar items that they're seeking.
Yeah, I think the biggest thing for most people is that they want cash flow and they want financial freedom, right? And when they continue to do, and we even, I built out a financial independence calculator. For me, that was a big aha moment, just going in, plugging my numbers and seeing how long it would take me to get to financial freedom. Because most people, it's like not really having a goal or knowing which direction you're moving towards, right? And so if you go to generationalwealthmd.com, there's a financial independence worksheet in the resources section. I highly encourage everyone plug it in, because a lot of people are burnt out and they really want to have options. Having passive income gives you autonomy. You're able to say no when you want to. And so oftentimes it's just like not really having time for their family, not having autonomy, feeling burnt out and wanting to get to that point where they have the income and so they can make decisions that are better suited to their life. But then the barrier I feel to real estate investing always is, oh, I don't have time, or I don't have enough capital. Those are barriers. And then the other big thing is like, I think it's too risky. I don't know enough to invest in real estate. And so our goal has always been to try to solve for that, right? And so that's why, the key focus is your asset allocation needs to shift. If you need to compress those timelines to get to financial freedom, you're putting in time to educate yourself now so that you can buy back future time, right? That's how you need to be thinking about it. Time, I say real estate investing is very fluid. For the longest time, I had an active real estate portfolio, short-term rentals, mid-term rentals. Now it's completely passive, all converted to long-term rentals. My property manager takes care of it. There's always a way to work in real estate where you can keep things super, super passive, right? You could have a short-term rental and you can hand it over to a property manager if you wanted to. There are so many people, and now all I do is primarily invest passively in our syndications, which is passive investing. And so you can invest in real estate and can be completely, time efficient, where you're spending very little time on your portfolio. No, those are options. As far as capital, there are so many ways to invest in real estate where you can bring in, I believe for syndications, passive investing, we can sometimes go down as low as 25,000 just to help people get started. But it's not like you need a six-figure check to start investing in real estate, right? And then when you're investing directly and owning, there are ways to creatively finance. There are ways to get in with 10% down for short-term rentals. Some of our students like seller financing. There's a lot of flexibility. And so if you don't have time, then educate yourself. There are ways to invest in real estate with lower capital and risk. It's all about risk happens when you don't know what you're doing, as Warren Buffett says. And so it's about educating yourself. And so we like you, we have a podcast, we have blogs, we have a coaching program to actually walk people through the steps so they can understand everything they need to know about running numbers, asset protection, accounting, bookkeeping, all of those things. And I think that's where, just investing the time to educate yourself can really break down those barriers and help you take massive action. For passive investors, we have a guide. It's a free guide. I say it's 1 hour of focused reading. Just sit down and it helps walk you through how do I build a buy box that makes sense for me? How do I do due diligence, vet the market, vet the sponsor, vet the deal? And all of this can seem very confusing, but once you know it and you do it once, I think it's this huge, steep learning curve. But once you educate yourself, you're really de-risking your portfolio, eliminating risk. And that's what we do. Even as operators, we're constantly learning, improving, educating, underwriting, and reducing risk from a deal. It's totally possible to do that in real estate. And so for those of your listeners who are interested, that's gwcapital.com/guide in lowercase. But I think those are the biggest barriers. Like the pain points are not having time and autonomy, and the barriers are always not having, again, time to invest in real estate and then feeling that's risky.
Yeah. And also, do you ever have people that struggle with a trust perspective, which is a limiting belief on investors who aren't comfortable with someone else managing and operating it? Kind of, is this a Ponzi scheme? How do I know you're a good actor and a good apple? How do you overcome those objections within your group? Because naturally you're going to be working with a lot more intelligent people, being that they're doctors, right? So they could be skeptical at some certain things. Maybe they think they could do it themselves, but they don't have the time. How do you overcome those barriers?
Yeah, that's a great question. And I think, sometimes I'm astounded by how someone I haven't met in person is willing to invest to bring a seven-figure check to the
Yeah.
table, right?
We've
Because
had that
if I
before too,
think
where it's like
because
awesome, and then some people will even give you 50K, even though 50K is very not meaningful for them, right? But they just
yes,
don't trust. They need to get through that barrier.
absolutely. And I see if I had, 10 years ago, I probably would have had major trust issues also, right? Because I wasn't as educated. There are the multiple options, right? Being a physician, I think really helps because, especially with other physician high income professionals, because they can go look me up and being a physician really helps. I think that's one thing. The second part is building a community and really educating. And I think the focus has always been that more than anything else. And I think that really helps us stand out because, we have a podcast, we have tons of free resources. I run 2 free virtual events every year where we have thousands of physicians and high income professionals show up. And all we do is educate. It's like 9 hours because the podcast is very piecemeal. You kind of have to like listen to a lot of things, YouTube, podcast, blogs, and put everything together. But I like to give them like a broad overview of everything and take them through things sequentially. And that's completely free. I think people love it, appreciate it because for a free event, it's like so high yield. I do a lot of Q&As, and so the educating really, really helps. Building the community really helps, and then track record, obviously, like as we get into more deals, even with every webinar we do, just like you guys, right? And I know you and Rob are like that too, because sometimes I feel like we lean too much into giving people too much information because I really want them to know everything before they make a decision. So even when investors come to us, I'll be like, have you read the guide? I really want you to be doing your own due diligence as opposed to just trusting me, right? So we really lean into it. But which is why I also think we have this whole component where this whole vertical where it's geared towards people who want to invest actively, have control, buy their own deals, by investing their own long-term, short-term, mid-term rentals, multifamily. And we have tons of resources for that because there will always be the people who will want to have absolute control and trust will always be an issue, but they have tons of options too. And so I feel like we cater to all of those people in different ways. But yeah, I'm actually completely honored and always surprised by how someone can write a seven-figure check and not having met someone and just having met them virtually. But I think track record and being a physician really helps.
Yeah, no, I relate to so many of those things that you said there. And kind of the interesting way to look at it is I'm sure like you, someone joins your group, maybe they're skeptical, but I almost love when someone's skeptical that comes into our systems, comes to the top of our lead funnel that maybe has never invested before. And they're like, okay, well, what's going on? They kind of grill you. And then what I always say to them, I almost disarm them. I'm like, hey, listen, I'm going to be in this business indefinitely. So if
Yeah.
you invest today, I'll be really happy. If you invest in 5 months, I'll be really happy. If you invest in 5 years, I'll be really happy. If you never invest, I'll be really happy. But you can watch us for as long as you need and as long as
Yeah.
you see fit to feel comfortable, to get into our system, to make sure that you make a good educated decision, because I want you to love the deal as much as all these other investors are coming into this deal, love the deal. I need you to love it as much as I love it
Yeah.
because we are married together in illiquid investment. I don't want to take just anyone's money.
Yeah.
And I'm sure for yourself, you have those similar things as well, where, hey, don't just take my word. Why don't you just watch until you feel comfortable? And then you can also offer them, the extra layer of trust, which is, hey, here's how you actively do it. I
Yeah.
imagine a lot of people who go active then realize, actually, well, maybe I do want to go passive, but you get them in there from that, original thought process.
I would say 30% of the people in our coaching program invest with us passively. Some of them, I would say 30% end up just learning, educating themselves, and then investing passively. But I would say another 20% invest in, they go all the way towards the other extreme, right? Short-term rental, super active, self-managing it, but they also invest in syndications because they want a little bit of diversification and different strategies in their portfolio. And so something else that came up for me, Greg, is like the disc profile, right? And as we're talking to investors, because I do a lot of calls with members of the community, everyone's going to have different sets of questions and behave differently depending on their disc profile. And so you'll have the Ds, the people who have a D personality where they really want to know what's going on, and they will be they will be blunt, they'll be quick, they'll be like, I need to know about all of this, and you cater to them by really explaining and helping them understand what they need to get from that. And then there will be the I's, I believe I's intuitives, right? The people who are just like, Param, I love you, I trust you, I want to go into this deal because I want to work with you. And there again, I'm like, okay, I know that, but I need you to look at this. But for them, it's more a trust factor. And then there'll be the SCs who are like checking the box, okay, this is what I need to do from my due diligence perspective, can you help me understand all of this? And so really understanding people. And I think like for all of us, as we're building a community, a big part of it is meeting people where they are and giving them what they need to help them succeed. And so that's always been the goal.
Yeah, there's some people that really just need to know the story. They don't care about the
Yeah.
underwriting. They want to know the story.
Yeah.
And why should we choose this deal over another deal? And
Yeah.
there's some people that I don't care about the story because you can manipulate a story, you can create
Yeah.
a story, you can fabricate whatever it may be. Show me the underwriting, show me the assumptions, show me your
Yeah.
entrance cap and exit cap, how you can justify both ends of the spectrum there, and why this deal is good compared to the other ones. It's not a one size fits all situation. So to meet people where they are is very smart. It's not being manipulative. It's just kind of choosing and working with their brain. And that's really what sales is figuring out how this deal will help them and what are you solving for. And I'm sure there's a lot of people that
Yeah.
you've spoken with. It's like, hey, actually, I don't think we're a good fit to work together. At this point,
Yeah.
we're kind of at the point where we just tell people no if we don't think it's the right alignment. We often
Yeah.
tell people, hey, if you're looking for the highest returns, we're probably not the deal for
Oh
you.
my God, exactly.
Yeah. So have you ever had to go through that with some people who are maybe irrealistic about their return profile, maybe exercise caution with them?
So a few things, we have 20,000 people in the community and maybe 1,000 investors who invest with us, right? And so I feel like a big part of that is going to be educating, and then a fraction of the people are going to work with us, right? And those people are always, like you said, they need to be the right fit. We tend to be very conservative, which is why we like working with Lone Star Capital in our deals. We're not going into risky ground up developments. We're not at the stage where we want to go into bridge financing just because we're at the bottom of the market cycle and it's the best time, which is why we work perfectly well as partners. We're at the same level in terms of being conservative. I believe our community, the majority of our community they prioritize capital preservation over returns. And I always tell people, when you look at returns, and like you said, everything can be glossed over. And so that's why I say, look at the guide, go take a look at the assumptions. I always do an underwriting video for each of our deals where I go through the actual Excel spreadsheet, which is not the glossed over, OM that people get, but it's like the actual Excel spreadsheet. We send it over to our investors, especially those who bring large checks, or where we know that they want to do their own due diligence. And I'll say, these are the assumptions. This is what it looks like. Play with it. This is the sensitivity analysis table. Take a look at it. I want you to be very comfortable with what you're looking at. But I always tell people it's returns, compare returns. But when you're looking at returns, always look at the assumptions. That's important. But you're also, whenever you're looking at a deal, also looking at the risk profile. So make sure when you're comparing deals that you're also looking at comparing the risk profiles of two deals. And so the risk return profile, assumptions, a lot of those things need to go in. I have a lot of investors who will come and say, I'm looking at this new development and it's not the space that we want to be in at this time. And I will tell them, great. And I will help them with analyzing the deal. And I'll say, I want you to go and check the track record and see who they're working with and make sure they have a great track record. And the reason I even started this, Craig, because I was all like, let's be active. Let's tap into the tax strategies. I had a friend who was a physician who invested $500,000 with another group. And people always brought their deals to me, right? And I would say, can I take a look at the actual underwriting? Because I don't want just the OM. Oftentimes I wouldn't get it. It would be crickets after that because most people don't give that out. But then I told them the track record, they don't really have a solid track record. I want you to deep dive into it. And I don't necessarily, give more information. He ended up moving forward, and now the partnership's fragmented, and now he's trying to get his capital up, and there's no legal recourse, right? That's why I started doing this. And a big part of what we do, we are very conservative, like Lone Star Capital and the deals we go into. But again, not everyone invests with us, and we do assist them in underwriting other deals. But the focus is always on helping them do their own underwriting, which is not just the numbers, but it's also analyzing risk in a deal.
Yeah, no, and I think you don't want every investor because you want to have a certain philosophy. If you have a certain philosophy, like being conservative, like looking for certain things, you're actually going to attract a really incredible investor base that's more loyal and doesn't look like you as a commodity, meaning, what's just the highest return? Where can I go down the block to find the next thing? So you're super targeted and have a super curated audience with what you've been able to create, with your avatar and profile, which is so unique and why you're really one of the best in the business. So I just feel so humbled that, you choose us as a partner to work with because you have so many options.
And, I think like all of us, right? And which is why we work with very few select partners and Lone Star Capital too. the name of the game is also innovating and constantly bringing new things to the table. And so in the last few years, all of us have shifted our strategies. We've shifted our criteria. We're very intentional about it, and we educate our base. We've done loan assumptions. That's really helped make the numbers work in the last few years. With Lone Star Capital, we've done those tax exemption deals where you're getting a very low risk property with a low risk profile, but significantly higher returns. We love that. And we're constantly looking for deals like that. But we also created GW Capital Fund One. And the reasoning behind that, and it's a lot of work on the back end. We're doing it in a way where we are, in terms of cost, we're significantly lowering costs to where it's 25% of what other funds have in terms of expenses, because otherwise those costs are passed on to our investors. But the goal with that has been to negotiate better returns for our investors, which, obviously we're able to do now because we're going in as a fund. It's a customizable fund. Our investors still come in. It's not a blind fund. They get to pick and choose which deal they want to go into, how much capital they want to put into it. They have a better investor experience, right? Everything's in one place. All of their paperwork is very streamlined. You get a single K1, and if today's like Merrill Edge, right? Like you have all these different deals, but your process is very streamlined. And so that's always been the focus for us. So it's bringing those conservative deals, very low risk. We're really focused on those higher returns, but not in a risky way, right? Not by eliminating a lot of the variables. Well, when we work with you also, it's been fixed debt. It's been very, very conservative. But then we're also innovating. How else can we push up investor returns and ensure that, they're getting better terms than, say, the retail investor?
Yeah, it's super crucial that, and you have that. And I think something with the model that you have there from your GP fund that flows through that fund, super cool, because someone can come in with, a $25,000 check, a $50K check, and get really nice returns, which is a benefit to working with you, of course. So That's one of the benefits that you have bring. And that's also a credit to you from what you've created. You've created a platform that truly brings outsized amounts of dollars to opportunities. And you've earned that right and that privilege because of who you are. And the crazy thing is that all it's going to take is a couple of market cycles and a couple of deal flips to come through where, call it in 10 years time from now, you're going to be bringing somewhere between $5 to $12 million a deal recurring. That's pretty crazy to think about, but that's just kind of the trajectory you're heading in. So the fact that we're on the rocket ship with you is super exciting.
And it's amazing for our investors also, because once they have that exit up, Craig, then they're going to see double the capital going into the next deal, and the cash flow is going to go up significantly. And like you said, as market cycles shift, we're going to see more cash flow. Things are going to open up, right? And so I'm very excited. We're like you. We're very excited about acquiring in the next few years. We are educating our investors so they realize the opportunities because this is a time where, again, it's market psychology, right? It's a time in the market cycle where some people have had capital calls. Some people have lost capital in deals. And so there's fear, there's an election, everything's in flux. And I know you and both Lone Star Capital and GW Capital, we've done member loans where we put our own capital into the deal, but haven't had capital calls yet to date. But this is the time for investors to go in and really, and I'm excited about when they have those exits and then they 1031. Even from an investor perspective, now they can have double the cash flow coming in. And so that'll be, I think, a great pivotal point for a lot of people.
Yeah. And just to follow up on that, I think something to think about for those, call it, people who are like me, I just turned 30, and let's say I invest $100,000 today, right? So if I invest 100K, I might make somewhere between $5,000 to $7,000 annually in that cash flow, about $500 to $600 a month. Now that might not seem like meaningful dollars today, but with the compounding benefits and the cash flow going full cycle and stacking and stacking and stacking, by the time I just say, let's call it 50, if I keep making, hundred thousands of dollars of contributions annually, you're going to look up and have so much money that you will be able to own your day to day, and everything that you're doing will be coming from a place of, do I want to do this? Not, I have to do this. And I think that's the mindset people really need to start thinking in, is that, hey, it might not seem like a lot today, but that small ripple will create a very large wave.
Absolutely. That time value of money, which is why sometimes I tell people, and I tell people this all the time, they'll be like, Param, it's the first time and I'm scared. I'm a single mom. I don't have like a backup income. All I can do, I can do more, but all I want to do is 25K. And I'll be like, just do 25K. If that's what gets your foot in the door, because it's not about this deal bringing you generational wealth, But this first deal is like the first deal sets you free. It's going to shatter so many barriers when you see that deal go full cycle. And I don't want you to wait to take that step. And so, yeah, so it's all about starting as soon as you can. Really, again, looking at your portfolio, knowing where you want to be in terms of asset allocation, doing your own due diligence. But when you do that and you start taking action, I'm excited for what things are going to look like for you when you're my age, Craig.
Right. Well, the other interesting thing too is just the excitement to get into these deals and the cash flow created, the upside associated, getting your time back, having the ability to live life on your terms and to get that going there. And then also, the other thing to consider is how, do you want your life to look? Do you want to work your whole life? Do you want to keep working? You can supplement your income in through this stuff. So you can take more risks if you start at this point in your life. If you start, like yourself, or like I, a little bit earlier in the spectrum in the scheme of things, that will help you kind of, as you said, shrink that gap. Speaking of which, you mentioned you had a calculator on your website in your coaching program. What does that calculator consist of?
So we have tons of resources. Like the first thing I would say for anyone listening is that financial independence worksheet. It's like a retirement calculator. So it goes in, and if you go to generationalwealthmd.com, go under resources, it says financial independence worksheet. It says, okay, what's your current portfolio value in stock? And you could do stocks or bonds or real estate, whatever. How much are you contributing annually, saving and contributing monthly? And then what is your financial freedom number? How much do you need every year to be able to be financially free? And then it spits out how long it's going to take you to get there, which for me, like that was the first step in my journey, right? When I saw 17 years and I was like, oh my God, there's no way I want to do this for 17 years. That's what helped me pivot. And so I think that's a great starting point. But for those of you who are thinking of investing in, say, short-term rentals or long-term rentals, we have a short-term rental calculator, a long-term rental calculator. I built those from scratch with the intention of, on the go, you're just plugging numbers in. You can see if this property is profitable or not, right? And so I think it's a great starting point for people who are saying, I want to buy a long-term rental, but when I started out, I didn't really know how to do that. I looked at PITI, which is principal, interest, taxes, and insurance. And I said, oh, if my rent is above that, I'm good. But I didn't know how to factor in property management or HOA fees or utilities or vacancy, maintenance, all things that you need to plug in. So it gives you a more reliable way of understanding if you have a profitable property at hand. And so I think it's a great resource, especially for someone thinking about short-term rentals. Don't just jump in because of the tax savings. The property has to, be a profitable property and worth your time investment in it. And so I highly recommend using those.
Yeah, and another thing you mentioned too is just market timing. And some deals are not doing so right now. Some deals are doing better than others. It's impossible to have a perfect track record. This business is inherently cyclical. But I just want to have a message out there, and I'd be curious to know what you're saying to people too. Naturally, there's a lot of fear in the market. Headlines are starting to catch up to realities of, deals struggling and whatnot. It's no secret that commercial real estate as a sector itself is not doing great, but unfortunately, commercial real estate does include office and other asset classes that are not performing nearly as well as some of the stuff that you mentioned, like short-term rentals, multifamily. I'm sure you have a debt investing arm inside of stuff that you do there for certain specific investors, but I just think it's a really important thing to think about where we're at from a cap rate perspective, from a debt perspective. When there's kind of uncertainty like we're seeing in the market right now, uncertainty is just basically a synonym for opportunity, as I call it in the real estate business. This is the time to really go out on a limb. And if you're bold enough to invest in 2021 and 2022, and even 2020 when the market was super hot, you should be more excited to invest right now. So I just want to really make that note there that this is the time to kind of go all in on investing. So with that said, have you had to kind of overcome some of your investors' limiting beliefs pertaining to the market being more challenging right now? Maybe some people who have had bad experience with investing in the current market cycle?
Yeah, absolutely. And I'm sure, I mean, it's similar to what all of us are going through. And I always say, don't time the market. Time in the market is more important than timing the market. It's always about dollar cost averaging, like you would in the stock market. But it's really hard for people to understand that, because March 2022, when we were at the peak of the market cycle, and that's typically what happens, right? It's always cyclical. At the top of the market cycle is where there's so much optimism, and everyone's just looking at, our hindsight is always just like last few years. How do people do, right? So everyone was super optimistic, but that was when we had the most risk in the market. And where we are right now, and the best part is, like, with interest rates starting to come down and rent starting to go up in some markets, we're already, we've hit the bottom and we're on the way back up. And although this is the part of the market cycle where we have the least risk, it's the part of the market cycle where people are confused, people are maybe sometimes upset, sad. So not really the environment where you're going to hear people say, hey, this is the best time to invest in real estate. That's why we educate, right? If we had to pick a market cycle, and I never time, if we had to pick a market cycle to start investing, this would be the best time to do it. And then again, even there, you have a risk return spectrum, right? Even within syndication. So if you're picking multifamily, there's the lowest risk there because occupancy doesn't fluctuate as much over there. From the market cycle perspective, there's less risk right now, right? If in terms of strategy, like look at the assumptions, look at the strategy, like the last few deals we've done with Lone Star Capital have been tax exemption plays that were in place before we even acquired the deal. And so you're getting these core plus assets with so little risk, and we're still getting higher returns, right? So you're able to control so much as far as the deals that you go into. So know where you want to be in that risk return spectrum, be very intentional about it, and understand that we're in like a unique opportunity probably for my generation. This is one of the best times to be investing in real estate, very similar to right after the 07, 08 real estate market crash. And so that's what we educate people about. And I always say it's not about emotions. Lean into the data. The fundamentals for multifamily investing is very, very strong. We're still in a place where we have demand supply shortage for the next decade or two. And so as long as you're doing your own due diligence, it would be you need to really be thinking about asset allocation and pouring capital into real estate, into the right deals.
Couldn't agree more. And thank you so much for the words there. And, it's all about going back to the fundamental, which is education, which you've done such a great job on, and why we probably get along, because it's conversations like this that really help people make very good and informed choices and not impulsive ones. With that said, what are you most optimistic about? There's obviously a lot of negative news coming around with, economy stuff. Obviously, an election is always a wrench in the equation. But what is getting you most excited today for capital raising, for education at this point of the cycle?
Well, I think we're getting assets at discounts right now, right? So whenever you purchase a discounted asset, your returns are oversized just because you're acquiring it at a good basis. So that's a great thing. I think also, interest rates dropping, so it's a good environment to be in. But I feel like a lot of us, and this is the thing about obstacles, right? Obstacles are actually opportunities. The operators today have been through a cycle, and we've learned so much. And so, even from that perspective, I think we're all in a better position to really vet our deals. And I let's say 3, maybe 4 years ago, this would have been a time we would have considered variable rate debt just to get better financing terms. But any sophisticated operator who is looking out for their investors, and I feel like we fall in the same bucket, we're being very conservative, even at a time where most people would probably take on more risk, right? So I think everything is falling into place, and we have a good run. Again, a few years from now, 4 or 5 years from now, we'll have to be more intentional about our acquisitions. But right now, we can go in. We're getting really great assets, and all of us are experienced enough to know to stay conservative, and we really want our investors to do the same thing, essentially.
Yeah. Final question for you here. You've been so generous with your time today. Thank you so much for coming on and giving us some of your knowledge and insights. What is one nugget that you would like to share with the audience? Maybe one piece of advice or paradigm shift that occurred in your experiences that you would like to pass on to the audience today?
So I could go different ways over there. I think the biggest thing is always going to be, asset allocation. It always comes back to asset allocation. We'll take a look at your asset allocation. If you're ideally, I believe people should be between 30 to 50% in real estate. And if you're not there, then you should be educating yourself and taking steps, right? Because it's not just about diversification. It's about lowering risk. It's about being tax efficient and really getting those higher passive income streams, because end of the day, financial security gives you you need to have that net, right? And so start thinking about it. And for those looking at deals today, I would say even in this environment, the two big things I tell all our investors is take a look at debt, because in any deal you want to buy right. In most deals you can buy right now. You want to be able to hold on to the deal, right? And you want to be able to control the things that are not, market cycle we can't control, but there's so many other things we can control. But the ability to hold on to a deal, I think that's critical if you're looking at de-risking. Debt is going to be very important. So take a look at the debt terms, right? And so longer term debt, fixed interest rate is still what I would say is most conservative. And then look at cash flow. If you can get into deals today where it's cash flow heavy day one, I'm not saying, at the end of year one, because that's still based on the business plan, but day one, if that property has high cash flow, then that's the buffer you need. And I would say if you can focus on just two things, because sometimes it can be overwhelming, right? Due diligence is like this big thing. But if you can look at those two things and you can find and vet good deals and lean into those.
Yeah, I love it. Param, where can people get a hold of you, learn more about yourself, your offerings, your systems, and things of that nature?
Yeah, so we have a podcast, Generational Wealth MD. GW Capital is our passive investment opportunities. That's where we have everything. I would say the guide is a great resource for people. So gwcapital.com/guide in lowercase is a great resource for anyone trying to do due diligence with apartment syndications. And then generationalwealthmd.com is our website where we have tons of resources for those who want to actively invest in real estate, say short-term rentals, long-term rentals, multifamily, tons of tools. And that's another way to get in touch with us.
Awesome. Well, thank you so much for being on the show. Thank you so much for being such an incredible partner and having Lone Star be a part of your tool belt there. For all the listeners who tuned in today, thank you so much, and reach out to her. She is a guru, an expert, and a thought leader in this world, and it's going to be so fun to watch you only grow more in the business, raise more capital, partner more deals, and have more fun together. Thank you so much.
Absolutely. Thank you so much, Craig. I love the impact you're having. I love how you're so education focused, and hopefully we're doing the same thing and helping people.
Yes. Well, thank you so much for all the listeners here today. We really appreciate it, and we'll hopefully see you next week. Peace.